Some MPs have said that shops and services should be forced to accept cash in the future to help protect vulnerable people who rely on it. My name is Jack Revis and welcome to this week's episode of Tax Tidbits, where cash is going out of style, but for millions of people in the UK, that's a serious problem. MPs are warning that if shops keep going card only, the government might have to step in and force them to accept cash by law. While most of us are tapping phones, watches and flashing cards, there's vulnerable groups like elderly shoppers, people with disabilities and victims of domestic abuse who need physical money to stay safe, budget or just get by. Currently, shops can refuse cash if they want to, and more of them are doing exactly that. Car parks, buses, even leisure centres are all going digital. But that leaves cash users stuck with fewer options, higher prices, and sometimes no access at all, and that is called poverty premium, and it's growing. The Post Office has just signed a deal to keep cash services running until 2030, which is good news, but campaigners say that's a plaster on a bullet wound. So should shops be forced to accept cash, or is it time we all just moved on? New figures from Nationwide show house prices fell by 0.6% in April, the biggest monthly drop since August last year. Why, you ask? Because buyers rushed to beat a stamp duty hike that kicked in on 1st of April, and now the market's catching its breath. March was frantic. People scrambled to complete purchases before the deadline. But in April, demand dipped, transactions slowed and prices edged down. Here's what's changed. You now pay stamp duty on homes over £125,000, not £250,000. And first-time buyers, your tax-free limit dropped from £425,000 to £300,000. So yeah, a lot more people are now paying to get on the ladder. The result? The market's still 3.4% more expensive than it was this time last year, with the average home now costing just over £270,000, but that price tag could be on the move. There's a silver lining though, sub 4% mortgage deals are back. The catch? Most of them come with chunky deposits. Still, with interest rate cuts on the horizon and lenders battling for customers, that April slowdown might be short-lived. The market could be gearing up for another run. Here's some news from the latest tax update. Payrolling Benefits has been delayed by HMRC. Originally set to kick off in April 2026, it's now been pushed back to April 2027. Software providers have said they simply didn't have enough time to get everything ready in time to handle the mandatory payrolling of income tax and national insurance on benefits. This is a huge relief for businesses, especially with all the other tax changes coming April 26, like making tax digital for income tax and compulsory identity verification on company's house. The delay means firms get an extra year to prepare for the move to real-time reporting of benefits in kind, which is no small feat. Experts have welcomed the change, saying it gives businesses some breathing room. So while the push for modernisation, the tax system continues, at least for now. Businesses don't have to worry about adding another compliance challenge to an already jam-packed calendar. Growth in the UK's economy is slowing down, and it's all thanks to US trade tariffs. According to economic forecaster EY, the UK's growth forecast for this year has been downgraded from 1% to 0.8%, with 2026 forecasts also being slashed from 1.6% to 0.9%. This has been caused by the tariffs imposed on UK exports, by the US. The tariffs have caused uncertainty, which in turn is dampening business and consumer confidence. Firms are more cautious about investment, with high levels of uncertainty in global trade causing a slowdown in spending. And with the US being a key market for UK services and goods, accounting for about 16% of UK exports, the impact is real. But it's not all doom and gloom. While business investment is weaker, there are some glimmers of hope. The service sector is still expected to grow, and predicted interest rate cuts should help to boost both household and business spending. EY expects the Bank of England to cut interest rates to 3.75% by the end of the year, and further cuts to 3.5% in February 2026. Last week we told you that DHL is putting the brakes on shipping anything over £600 to the US. However, this week they have now U-turned on this and are now shipping it back to the US. DHL said, nope, not doing it, blaming Trump's latest tariff shakeup and the surge in customs clearances that came with it. But after some behind closed doors talks with US custom officials, they've found a workaround and are accepting high value parcels again. To be fair, the system was buckling. DHL was scrambling to clear round the clock paperwork and delays were piling up. So they hit pause. But thanks to what they're calling constructive dialogue with the government, custom regs have been tweaked and DHL's high value delivery lanes are open once again. This all ties into a bigger move from the US to close the de minimis loophole, the one that let cheap goods from China and Hong Kong slip in tax-free. That loophole shuts on the 2nd of May, and giants like Shein and Temu are already waving the red flag. So in short, DHL is back, high value shoppers can breathe again, but expect the tariff roller coaster to keep on spinning. And that's it for today's episode. Remember to hit like and subscribe if you liked what you saw, and share this with anyone you think might find it useful. See you next week.